Okay, well, I think as more and more sign on, we will go ahead and get started. Good afternoon. This is Bob Nachman with Nachman, Norwood, and Parrott. Welcome to our guests who are joining us, as well as our panelists today. It's really an honor for us to have such distinguished guests, and we look forward to a lively discussion. Before we begin, let me cover some housekeeping items. For quality purposes, we have all of the guests muted today. However, we would love to hear from you. So if you have questions, there is a Q&A button or tab at the bottom of your screen, I believe. You can submit your questions and I will keep track of those, and we will probably tackle those at the end of the rest of the discussion. Also, for compliance reasons, I will just say that the opinions that are expressed today are those of the presenters and not necessarily Nachman, Norwood, and Parrott. The information is for educational purposes and general in nature, and doesn't take into consideration your own personal circumstances. So it's not intended to be specific investment advice or tax advice for you. And to determine which strategies or investments may be suitable for you, please consult your advisor prior to making a final decision. Now let's get started. And as I said, it is our honor and pleasure to be able to present two experts in their field to our viewers today. Some of you may have joined us in the fall when we had Mike Townsend on, but today we also have Liz Ann Sonders joining Mike. Mike, for those who don't recall or who were not on the last call, he serves as the Vice President of Legislative and Regulatory Affairs and is Charles Schwab's Washington-based political analyst. He has 27 plus years of Washington experience and is the host of WashingtonWise Investor Podcast. He clearly has his ear to the ground in DC. And Liz Ann Sonders serves as Senior Vice President and Chief Investment Strategist at Charles Schwab. Liz Ann is regularly quoted in major financial publications, including the Wall Street Journal, the New York Times, Barron's, and the Financial Times. And she appears as a regular guest on CNBC, Fox Business, CNN, and Bloomberg. As a play on the old TV commercial, for those of you who can recall, when Liz Ann speaks, people listen. So welcome to Mike and Liz Ann.
Thank you, Bob.
Thank you.
Since we probably have a lot of ground to cover, and I'm sure we have a lot of interest. It's been an interesting time lately, and we have a lot to cover and probably have plenty of questions coming as well. But let's begin with getting both of your perspectives on the current landscape. Let's start with the economy. So Liz Ann, maybe you could begin by just giving us your broad overview of the unique year that we had in 2020, as well as your outlook for 2021.
Sure. So thank you. And thanks everybody for tuning in. To say the last year has been unique was obviously an understatement in so many ways, not just the nature of this crisis, a health crisis becoming an economic crisis, but the nature of what both monetary and fiscal authorities did to combat the crisis, not just in scope, but speed. And I think that helps to explain why we had such a short-lived bear market, and we're able to see that unbelievable sort of V bottom back last March. And that's somewhat natural for the stock market as a leading indicator to anticipate the turn in the economy, but there certainly was a very stark contrast between an incredibly strong market and a much weaker economy. I think when looking at the economy, there are aspects of economic data that has had a true full V-shaped rebound. In fact, to even better than pre-pandemic levels. One example of that would be retail sales. But there are still other parts of the economy, particularly within the labor market, that remain quite beleaguered. We're still about 10 million payroll jobs shy of where we were pre-pandemic. About 40% of people unemployed are long-term unemployed, so more than 27 weeks. We agree with the consensus, certainly, that the vaccine, pun intended, is a shot in the arm that the economy needs and does represent a light at the end of the tunnel. And I wouldn't dismiss the optimism associated with it. I just think we have to consider that on the good side of the economy, there really isn't much pent-up demand, because whether it's housing or autos, anything housing related, electronics, that's where we've had true full V rebounds. I think the pent-up demand is more on the services side of the economy, and just the nature of pent-up demand on services is just different. One example I often use is if you missed 6 haircuts during the pandemic and your hair salon opens back up, you're going to get a haircut. You're not going to get 6. And you could say the same thing about restaurant reservations, vacations, et cetera. So I think we may have to sort of curb some enthusiasm that the real surge we're about to see in economic growth, because we're going to be comparing growth this year to last year, we should just be careful of not extrapolating that too far into the future. And then the last thing I'd say is, I think one unanswered question is, how much secular change did this crisis unleash in terms of maybe more frugality, a desire to keep savings rate higher? And that, of course, will have implications for economic growth as we look ahead. So I'm optimistic, but I'm also paid to think about maybe what the risks are around the consensus.
So you mentioned this disconnect between the market and the economy, which I know we talk about as advisors, that the market is a indicator of the future, not of what is happening today. But can you explain for those guests, not only how come we had this disconnect last year, but is it possible that that when the news gets good, that maybe that's, the party in the stock market might be late at that point?
Well, I think that is a risk, because clearly, given what the market has done just recently off all-time highs, reflects a very positive economic outlook. And I think that that does embed some risk that to some degree we may be getting a little bit of a flavor of this week, with a bit of a corrective phase in the market. That said, even during, say, the middle part of last year, last summer into early September, when that disconnect view was much more rampant, because that was in the middle of a quarter where we saw a 31%, quarter over quarter annualized drop in GDP, Great Depression era, yet the market into early September was hitting all-time highs. But all you had to do back then is just peel back one layer of the onion to see that for the first 5 or 6 months of the recovery in the stock market, leadership was unbelievably concentrated. It was pretty much only in the big 5 names, the Apple, Microsoft, Amazon, Google, and Facebook, which were not just survivors through the crisis, but arguably thrivers. But in early September, on a year-to-date basis, the other 495 stocks were barely up, and those 5 stocks were up 65%. So I think, at least then, it was reflective of what was going on in the economy, a very small subset of winners and still a lot of pain. Since then, of course, we've had these series of rotations, fits and starts, which have been tied to the fits and starts in the economy associated with the virus, associated with fiscal stimulus. And I think that kind of pattern will continue. But given that the market is now effectively priced in that at some point this year, probably in the second quarter, we'll be back to pre-pandemic levels in terms of growth in the economy, a disappointment, I think, does represent a risk. But I think it's a pretty good shot that we do get within a quarter or two back to pre-pandemic levels.
Thanks. So Mike, last time we talked, I think was maybe weeks or a month prior to the election. And I was reflecting this morning on your comments, which to my recollection, the election turned out to be pretty darn close to how you were painting that picture. So what does the political landscape look like today as we have a new administration and new Congress, and what are the dynamics that you are watching as we speak?
Yeah, there's no question. We've had pretty much a U-turn in terms of direction here in Washington, and the Biden administration kind of getting its feet on the ground. They've been in office a month or so now, but a lot of people really look at the post Trump impeachment trial as the start of the Biden administration, and that was really only the last 2 weeks basically. So I think they're still trying to get their bearings. A couple of names to watch in the administration. No question, Janet Yellen, very familiar name, now Treasury Secretary, first woman in the 231-year history of the Treasury Department. She's clearly going to be a huge influence on the administration. She's definitely someone to watch. And just sort of anecdotally, she's out talking about different tax ideas that I think we'll probably talk about later in this conversation. Even the whole GameStop retail trading frenzy that happened, it was Janet Yellen who convened the first meeting of regulators to discuss what was going on. So I think she's going to be very important. The other name I'd watch in the administration is Gary Gensler, who is the president's nominee to be the new SEC chair. And obviously the SEC is very much going to be in the headlines here because of all that sort of GameStop related retail trading frenzy. His confirmation hearing is next week. I expect he'll be on the job by the middle of March and have a lot of eyes on him. On Capitol Hill, couple observations. One, and we did talk about this a little bit back when I spoke before the election, but one of the surprises of the election is that Democrats lost some of their majority in the House. We really thought that they would increase the majority by a handful of seats. They ended up losing about a dozen seats off that majority. And the result is right now they've got a single-digit margin in the House, which is very, very narrow. It's very difficult for Nancy Pelosi to negotiate that because she's got progressives on one side, she's got moderates, and she can't afford to lose very many. Then that is even more exacerbated, obviously, in the Senate, where you've got a 50-50 tie and Vice President Harris poised to be the tie-breaking vote on key issues. That is a really difficult terrain to navigate. Just within the Democrats, you've got Bernie Sanders and Elizabeth Warren on the progressive side. You've got moderates to conservatives representing red states like Joe Manchin, the senator from West Virginia, John Tester, senator in Montana. So just getting all 50 senators on board on the Democratic side, which they have to do, you can't lose one, is going to be a real challenge and something really to watch going forward. I think those narrow majorities are going to act as kind of a brake on the most ambitious proposals that the Biden administration has. They're going to have to find kind of more common ground, scale some of those ideas back. So those are definitely the kind of things that I'm going to be watching as the new administration gets ramped up here.
So while we're on that subject, obviously, as we speak, the administration is doing their best to get their stimulus package across the finish line. How do you see that panning out, and what's the timing?
Yeah, the House is going to vote late this week, maybe it could trickle into this weekend, but the House is going to vote on the whole package. So this is the $1.9 trillion package. You've got stimulus checks, you've got money for state and local governments, you've got money for small businesses, for vaccine distribution, rental assistance, food programs, increased unemployment benefits, all sorts of things. It's a big, big package. And they're going to vote on that. And once it goes through the House, which I do think it will at the end of this week, then it goes to the Senate. And things are a little dicier there. You don't have all 50 Democrats on board yet. There's a lot of debate still about the minimum wage and whether that should be part of this package. That's still up in the air. Maybe that package needs to be slimmed down a little bit to get all the Democrats on board. If that happens in the Senate, then it has to go back to the House and be voted on again. So there's still a lot of moving pieces here. The key date is March 14th. That is when the enhanced unemployment benefits that are currently in place run out. Democrats do not want that to lapse. They want to extend those benefits out through August and make sure that that gets done. it's going to be tight to get to the finish line by then, but that's where their real focus is. I think they can do it, and that's the main motivation right now.
So Liz Ann, on that subject, what do you think the implications have been from all of the unprecedented fiscal and monetary policy that we've seen over the past year, as well as if this new package is passed on, even on top of that?
Well, it certainly has represented kind of a bridge over the chasm created by not just the virus, but the impact of shutting the economy down, particularly last year. And as I mentioned, the scope and speed were unprecedented. And unlike the financial crisis, this was double-barreled both on the monetary side and the fiscal side. And I think it certainly contributed to the timing of the bottom last March, because literally on that day, the Fed came out and announced the creation of some of these backstop lending facilities. They weren't even in operation yet that's an example of the power of the Fed's words, basically saying, we've got the back of the financial system. And then, of course, on the fiscal side, and it caused a jump in money supply that has persisted given additional rounds and ongoing loose, easy monetary policy by the Fed, of a growth rate in money supply, M2 money supply, of more than 25%. Now, a lot of people have in their mind that that's basically an inflation accident waiting to happen. And we've taken sort of the decided opposite view of that. We do think that there is some inflation kind of building in the pipeline right now, but it's more of the price shock variety and/or a function of what they call the base effect, given that, much as I talked about with economic growth, we're going to roll into data soon where on a year-over-year basis, including for inflation numbers, the comparison is to a year ago, and measures of inflation like CPI basically went to zero last year. So we're going to see these percentage jumps. In addition, we're going to get some price shock implications of maybe where you do get a surge in demand that doesn't have a matching supply coming online as quickly. But that should be differentiated from the kind of systemic wage price spiral inflation of the, say, mid to late 70s into the early 1980s. Very, very different set of circumstances. And the factors that I think will restrain that kind of inflation from erupting in the near term are the fact that although we've got 26% year-over-year growth in M2 money supply, the velocity of M2 money supply, which just measures whether that money is going out into the economy and picking up speed and multiplying, that's literally on the floor, and has been descending for quite a few years now. In addition, we have a tremendous amount of labor market slack. So I think the point at which we might start worrying about that true systemic 70s style inflation wouldn't be at least until we see much less slack in the labor market and we get a pickup in velocity. In the meantime, though, we have plenty of inflation. It's just in asset prices, not just stocks, but more recently in commodities, obviously in housing. It's just not been of the real economy variety, but it has certainly represented an important income replacement that I think allowed the economy and certainly metrics like retail sales to rebound much more quickly than clearly would have been the case if there wasn't any of that fiscal relief.
So other than inflation, and I get the question all the time, what happens at the end with all this debt that our country has taken on? My answer to that for 30 something years is I don't know how that plays out if we ever reach the point where the bill comes due. Do you all have any?
Well, here's my view on this.
We should be worrying about today?
Yes, but I think the implications of a high and rising burden of debt, particularly when debt growth is sharper, faster than economic growth, and you have that law of diminishing returns where each additional dollar of debt generates less and less economic growth. That high and rising burden of debt has proven historically in the United States, other parts of the world for decades upon decades, to basically act as a wet blanket on growth. So the implications are not prospective down the road. They might be if you think inflation is an associated risk, which we don't. The implication that we've been living with is that it acts on a big suppressant on growth, which in turn is why inflation has not picked up, even though we've had basically this surge in debt in place since the early 1980s. You could look at Japan too. Their government debt as a share of GDP is way higher than the US, and they're still fighting to get out of a deflationary environment. For all the cheering of the last expansion that of course ended with COVID last February being the longest in history, and that's factual, it was by far the weakest in history. And I think one of the reasons for that has been this burden of debt. So that is still something we will face. And then of course, in a rising interest rate environment, which maybe we have eventually, and to some degree we're starting to see now on longer term interest rates, although the cost of servicing our debt is quite low right now, that is going to surge simply by virtue of debt growth. And I'm sure Mike has an opinion on this. There is not much in Washington about which there's bipartisan support, but the sport of kicking this can down the road seems to be one that has significant adherents on both sides of the aisle. No longer, I think, is it the domain of Democrats to simplistically not care about this, just spend, and Republicans to care about it. As has often been said these days, we're all MMTers now. But there will be a price, as there already has been a price, in just a slower level of economic growth.
But I do think, to your question, where does it end? I mean, at some point, right, Congress has got a $2.3 trillion federal deficit before this stimulus bill goes into effect. And, it's a math problem at the end of the day. You can argue about the policies, but there aren't that many choices about what to do about it from a budgetary standpoint. And those are hard choices to vote for. And we all know these guys don't have I think the discipline or the stomach for taking those hard votes. So it is a mystery sort of where it goes, because you think, well, nobody's going to vote in late 2021, early 2022 ahead of the midterm elections to make dramatic tax increases or spending cuts or that sort of thing. So it's a tough one that's going to be looming over Congress for a long time to come.
A couple of the extreme assumptions are, one, the Fed and indirectly Congress or Treasury basically really lets inflation run hot, and you try to inflate your way out of this. Another extreme, which I'm guessing Mike would agree is probably much less likely, and it would be an extreme not just in the U.S. but globally, some debt jubilee, some massive era of debt forgiveness, and you kind of that view suggests you go into a period of hyperinflation, but then you sort of reset. I think that is a bit pie in the sky, but we'll see.
Well, let's move on to a hot topic of the last 2 to 4 weeks. It's certainly been fascinating to watch, what has happened with GameStop and other speculative actions we've seen in the market. What do you, what's your thoughts on what is happening? Are these, are they problems? And are they also, I certainly would put them as potential warning signs of a bubble out there when you see wild speculative behavior. Is this some kind of sign of what the future will look like, or what's your take on that?
So Mike, do you want to start, or you want me to?
I'll let you start, and then I'll talk about what Washington's doing.
Yeah. So I do think that we've got some what I've been calling micro bubbles in the market, driven by some of this rampant speculation, and certainly you can point to the last few weeks with broadly heavily shorted stocks, with of course GameStop specifically being the poster child for that. But we're also seeing it in other sort of arcane parts of the market, like penny stocks or low price stocks, weak balance sheet stocks. The concern, of course, is that everything that I just mentioned in terms of where a lot of the speculative hype has been is arguably has kind of a low quality banner around it, and that inevitably will burn investors. But I wouldn't yet consider this some, systemic overall market bubble. And what's interesting about the whole GameStop era is that a lot of the narrative is almost suggestive of this being kind of a brand new thing, a 2021 phenomenon. It's really the case that you can go back to kind of last June and July when you really started to see the surge in interest in and weight on things like daily trading volume of sort of these newly minted day traders. You started to see it in July and August, and there were lots of contributing factors. It was stimulus checks, it was people being at home, very comfortable with digital devices, given that we know that about 75% of these new traders are younger and male. You could certainly easily point to no sports betting, lots of ingredients into the recipe. But what was sort of masked at that time of that surge in sort of interest by this cohort and speculative behavior is initially speculation was in those leadership names, directly in the market, in the Amazons and Apples and Teslas and Googles, and in the options market. So they were leadership areas anyway, so it was harder to kind of distinguish the behavior specifically of that cohort. Very different story in January with the heavily shorted stocks with GameStop. But we think this is it's a phenomenon that is not going away anytime soon. Hopefully, there were very valuable lessons learned given how short-lived the whole GameStop saga was, and your heart breaks for people who bought in at the top and didn't quite know what they're doing. But the goal certainly on Schwab's part is to help be part of the process to take these newly minted day traders and morph them into more educated long-term investors. I should have also said, of course, that one of the ingredients to this that Schwab may have had a little something to do with, of course, was commissions going to zero. So
Sure.
that was certainly one of the big ingredients in this kind of puzzle we're all trying to figure out right now.
Which that leads to the, one of the reasons that the Robin Hoods can charge nothing is payment for order flow and other activities that go on Wall Street, rightly or wrongly. So Mike, last week we had a hearing in DC over this whole subject. Do you expect policy change? And what do you think about, you mentioned earlier, I guess his name is Gensler. Do you think this is on the radar of the SEC?
Yeah, I think it's going to have to be. Congress held a hearing, the House held a hearing last week, 5.5 hours over Zoom, lots of glitchy technology. You had the famous trader who goes by Roaring Kitty having to tell Congress that he is not a cat. So this is a little bit surreal, but all sorts of issues going on here, right? Role of short sellers in the market, the role of hedge funds in the market. How does the payment for order flow is really around how does the market plumbing work? What are the conflicts of interest inside that plumbing? You've got sort of disclosure to investors, right? As Lizanne pointed out, we all heard, really heartbreaking stories of people who just really didn't know what they were doing. What's the role of educating them and getting disclosure to them, that sort of thing. So there's all these sort of pieces going on all at the same time. House is going to do more hearings. Senate is already announced that it's going to have hearings in early March. But you're right, when this all kind of dies down, you get sort of through the grandstanding and speech making, this is going to be in the lap of the SEC. And the SEC is going to do a big study. They're going to have people comment on that study. They're going to think about what rules need to be changed. That's going to take for a long time. And this is a year-plus process to determine, what needs to be regulated here. So I think from the investor standpoint, it's going to be a while before you see anything really change. This is going to be a slow, methodical process to try to figure it out. And I would say it's not totally clear, what is really needed here yet, and even totally clear with the exception of some obvious, cases in the newspaper and that sort of thing. Who's the victim and who's really being harmed here? And so I think it's going to take a bit to sort all that out. But I think, whatever Gary Gensler thought his job was going to be when he was accepted the nomination to be the SEC chair, this is now his job.
Yeah.
Interesting. So I know in our business, in the months prior to the election and also in 2021, we were talking a lot and making decisions or pushing decisions out as it relates to potential changes in taxes and the estate exclusion that the new administration has at least proposed. And in our mind, that appears to be the risk of a higher income tax rate, the risk of a higher capital gains rate, and the risk of a reduction in the estate exemption or exclusion. So what do you think? Where do you think that stands? I think our clients are very curious, as we are, where you think that stands. What's the likelihood of any action anytime soon? Could anything be retroactive? So we're curious this is a hot topic around here, so we're curious what your thoughts are.
Well, I'll start, and then maybe we can ask Lizanne her thoughts on how it might impact the markets, particularly on the corporate side. But look, there's no question tax increases are definitely in play. I try to kind of put them in buckets of from most achievable politically to least achievable, and I'd put in that most achievable, the most likely bucket, an increase in the corporate rate and an increase in the top individual rate back to 39.6. I think those are the two that have the widest support among Democrats. Then I'd put maybe in the next level down, a little harder, but still in the mix. That's where I'd put estate tax changes, cap gains dividends changes, and really coming out of all this GameStop stuff, a financial transaction tax has gotten a little bit of momentum in Washington. That would be, a really tiny tax on stock and bond trades, which is really, really controversial, would be a big change to the markets, but has, there's some thought in Washington that would maybe curb some of the speculative trading excess that has gone on. I'd put in this sort of impossible category, wealth taxes of the type, Bernie Sanders and Elizabeth Warren talked about. On estate tax, you don't have all the Democrats on board. You've got Democrats who represent different kinds of constituencies. I always point to Montana, where you've got a Democratic senator with a constituency of big landowners and ranchers and multi-generation family-owned businesses, just thinks about it differently than some of his colleagues. It doesn't mean he's not for it or against it, but you just don't have that sort of unified Democratic perspective on this. So I would put those at less likely, but still in the mix. On the retroactive question, I think there's close to a zero chance they're going to be retroactive. Anything that happens this year, everyone in Washington who I have talked to about this issue is looking at a Jan 1, 22 type, implementation period at the earliest. And even Janet Yellen said in the last couple of days, she said, we're looking at tax increases that would be phased in a slow manner, very much a forward-looking thing. So I think what that means is that for everyone on this call, you're going to have time to know, to digest what is happening, and to talk to your good friends at NNP about what you should do about it based on your situation. So it's not going to be a big standalone tax overhaul bill. It's going to be incremental things attached to other spending legislation over the course of a pretty long period of time. So I think there's going to be time.
I think from a market perspective, there's you go back in history and you look at changes to capital gains taxes, you would think it would have sort of an immediate and direct impact on what the market does. But it's yet another example of the stock market being driven by myriad forces, that there actually is no consistent correlation in one direction, positive or negative, between changes to capital gains and what the stock market does. There's certainly implications for how investors need to plan, but I concur with Mike that at least something that is not retroactive at least provides some of that time. On corporate tax increases, it's really hard to judge at this point. I don't want to say a prospective higher corporate tax is not in the stock market at all. It's always hard to segment out one factor and try to define how much is or isn't in prices, because again, there's so many forces that impact the market. It's also a question of whether it's a simple just step up in the corporate rate without anything done sort of under the surface. So there's even back during campaign season, there was a lot of discussion of either in addition to or in place of perhaps that maybe more should be done on a corporate AMT because of that still fairly large swath of companies that doesn't have to pay tax at all. So it's a question of, do they tackle it that way? Do they just do a simple step up? There's also offsets to consider so far as we look at least 2021 earnings, because of record-breaking beat rates the last 3 quarters, largely because analysts just, when left to their own devices, just set estimates on the floor given the uncertainty with the virus. But the percent by which companies have been beating estimates has been strong enough that the estimate increases for 2021 have been quite robust. In fact, and this is a bit of an aside, but it helps to just put some numbers on it. As we rolled from 2020 into 2021, and you sort of tacked on one more future quarter to the forward PE ratio, which is 4 quarters of prospective expected earnings in conjunction with those increased estimates, you saw the PE drop literally overnight from 27 to 22. That shows you the improvement in the E, which could serve as an offset if we have to start to sort of haircut S&P earnings by virtue of a move up. If it is a simple jump up to 28%, most of the kind of economist consensus estimates are that you want to shave, 10%, not 10 percentage points, but 10% off corporate earnings, all else equal, which is never the case from a stock market perspective. So that's just an attempt at some rough numbers.
Great. Before we wrap up, let's move on to COVID and the vaccine. I don't know that either of you have a direct line to Dr. Fauci's office, but Mike, last week, President Biden said that every American who wants a vaccine should have one by the end of July. Do you think this is realistic from your knowledge?
Yeah, I mean, I think, the administration is saying it's going to have 600 million doses, available or cumulatively by July. That's enough basically for every adult who wants to get one. I think the question is sort of what constitutes success in this, and that's I think still a moving target. There's obviously some percentage of the population that is uncomfortable getting the vaccine, and what is the magic number, right, that sort of gets us back to normal? I thought it was striking that Biden said also that he thought we'd be back to normal by Christmas, which is a little bit different than July. So I think trying to sort that out is going to be a challenge for the administration to kind of keep expectations in the right place. I know, Liz Ann, what's your take on sort of what constitutes success in this?
Yeah, that's a great question. Is it? We also don't know sort of longer term impact of the vaccine. Everything from, can you actually get the virus again? What are the side effects? We've had this most recent issue with unbelievably terrible weather, obviously, in large swaths of the country that then kind of caused some problems in just getting the supply out there. Additional strains. I think I saw a report today that the South Africa strain is now in New York. I'm in Florida. We have more of the UK strain. So far, it looks like the vaccine is effective against that. But then it's just a question of a desire to continue to at least live our lives with some semblance of caution. I don't know that whatever the percentage is, and I agree with Mike, there's no way to quantify that we sort of flip a switch and the mass of individuals completely does a 180 in terms of, now I'm going to restaurants, I'm going to sporting events, I'm going to concerts. I just think it's going to take some time to morph from the environment we've been in for what probably will be a year and a half to whatever normal looks like. The other interesting aspect to a lot of this is, and I think of it in our business, I wish we were seeing you and your clients in person. I wish I wasn't just seeing Mike over Zoom. But I think the comfort level, the kind of adoption of doing certain meetings and events through digital platforms means that the future of sort of how we work, how we consume information, some of the efficiency around doing some things by video means that the new normal, and I hate that phrase, even though I'm using it, I just think is going to look different in a lot of ways. I don't think in so many ways we go back to everything looking like it did pre-pandemic. I think the world in many ways has changed, and some trends got sped up by virtue of the pandemic, and some of them are kind of brand new, but there are some genies that are not going back in the bottle.
So real quick, how much market risk do you think there is, if a more full-blown recovery takes longer, if we're not seeing a lot more people out and about in 6 months and it turns out to be 12 or 18?
I think there's actually kind of tail risks in both directions. I think clearly there's a risk that after kind of the surge, simply because of the math of year-over-year comparisons, that we don't get back to a growth rate that is maybe built into expectations. That's obviously a risk, just weaker economic growth. The other risk, of course, that I think is actually indirectly being discussed even more these days is there a risk that the economy overheats, even if it's for a relatively short period of time, and brings with it more consistent of these kind of price shocks and inflation takes hold? And if the market starts to sense that either the Fed is just going to dig their heels in and say it's transitory, we're not doing anything, we're going to let inflation run hot, that might be a risk. And or if the Fed does ultimately feel compelled to start talking about putting some of these tools back in the toolbox, so to speak, maybe having to taper some of the purchases of securities onto the balance sheet, do we have a risk of another 2013 like taper tantrum? So I think there are actually, outside of the consensus, I think there are risks to consider at both ends of the spectrum. But the nature of the virus and the unique aspect of this, I couldn't venture a guess as to if one of those risks comes, which one is more likely to happen. We're all sort of flying blind here in this very unique period. This is not your garden variety recession that you can apply, past history to look at leading indicators and what the time frame and magnitude of recovery is going to be. This is really different.
Yeah, thank you. So we got a few questions coming in before we turn to those. Mike, we talked about stimulus, taxes, the vaccine. What else should we as advisors or for our clients and guests as investors on this call, what else should we be watching in Washington this year and maybe beyond?
Yeah, I'd flag two things that I think all investors should pay attention to. Number one, lots of scrutiny coming on big tech companies. And with Democrats in charge, they're looking very carefully at antitrust issues around Google and Facebook. Just announced that there's going to be a hearing next month with the CEOs of Facebook, Google, and Twitter about disinformation and misinformation on their platforms, particularly around COVID vaccines and around election and post-election, misinformation. There's a lot of scrutiny on these companies, and we all know how important they are to investors. Either you're invested directly or through mutual funds or exchange traded funds. So many of us are, have a stake in these companies. I don't think there's, huge crushing regulation coming down the pike, but there's a lot of attention here. And Democrats are trying to figure out how do you maybe rein in these companies. So definitely something that's probably a long time process, but definitely something for investors to watch. Second thing I'd watch, and this is more of a probably fall 2021 type timeframe, but there's a lot of interest in a retirement savings bill that has bipartisan support in Washington. Would do things like raise the required minimum distribution age to 75. It would add a second catch-up contribution. So when you turn 50 today, you can contribute more to an account, to a retirement account. It would add another tier of stepping up of contributions at age 60. A whole bunch of provisions that I think are potentially really good for investors. Has bipartisan support. Anything that has bipartisan support these days is worth watching because there aren't many of them. And so I think that's something in the second half of the year to keep an eye on.
Great. And Liz Ann, real quickly, are there any specific data points we should be watching as advisors and investors in the months ahead?
I would look at a couple of things. One, I think labor market data is always important, but clearly in this environment, particularly seeing whether we're starting to see a healing in some of the scars associated with this crisis. So I mentioned long-term unemployment, the differential between permanent job losses and temporary, especially when we get past the expiration of this next fiscal relief bill, whether those scars are deep and not healing. So that's important. The other, this sort of morphs into Mike's area too, that I don't think is getting a lot of attention. I think tax filing season this year is going to be a nightmare for a lot of people. Just there's so many changes in terms of compensation, unemployment compensation, especially given to gig workers, and how we account for working from home and across state lines if you work for a company in one state but you're working from your home. Not to mention what GameStop saga showed about how many of these day traders didn't take at all into consideration the tax implications of what they were doing. Really sad stories of traders that were making 200-300 trades a day and just got the first of 35-page 1099s, and they have multiple accounts on multiple apps, and they're going to wipe away those fairly limited gains just trying to figure out taxes. So I think that's going to be a big headache. I'm not quite sure exactly what the market implications are, but I'm surprised it's not getting more attention.
I think some of those parents are going to be paying for the 16-year-olds who had all capital gains and didn't know they owed taxes.
Yep.
Anyway, we have some questions coming in, and I'm just going to say to the audience that out of respect for Liz Ann and Mike's busy schedules, we will try to get through these rapidly so that we can end on time in 12 minutes. So here we go with rapid fire. And we'll see who wants to take which one, but Monday morning, the New York Times published a picture from the surface of Mars. A story also on the front page concerned the inability to keep power and water systems working in the fourth largest city in the USA, to say nothing about most of Texas. What does that tell us about the future? I don't know if you guys are going to look into your crystal ball on this one.
I'm gonna toss this one to Mike, only just thinking about sort of policy side in terms of energy.
Well, I'll start on that one. First of all, obviously, I don't think a lot of people realize Texas is like its an entirely own energy world, right? I mean, it has its own grid, and I think we saw some of the ramifications of that. So, like everything that's in the policy world, that's going to be a long process to unsort and figure out who's to blame. And boy, the more I read about the crazy system they have for getting your energy down there, the more amazed I am. But and then I think with everything that's gone on over the last several months, I think if you can't look at what happened on the Mars landing and be pretty excited about the country's ability to still get big, giant, impossible sounding things done, that was a reminder that we still have that. And I think maybe that's kind of a Pollyanna-ish comment, but I just thought it was really cool. And I think, it's the sort of thing, frankly, we just needed that. And so I just thought it was a good thing.
Okay. What effect would a change in minimum wage have on the market?
There is obviously a lot of controversy, and the problem is that the data, you can pick and choose and support both sides. That is the rub, of course. If you look at the history of minimum wage hikes, there's several factors that kick in. For some small businesses, it acts as obviously a bit of a tax. And the argument is that why would we apply that in an environment where small businesses are already on shaky ground? Even if you view it to be the right policy, maybe do it at a point where we have a bit more economic stability. Then the question is, if you're in more stable economic environment or stronger economic environment, there is that desire and tendency for higher minimum wage costs to be passed on to consumers. So there's been a correlation historically to higher minimum wage and inflation. But obviously, it is to the benefit of workers. And it's very easy to use words like absurd when you think about the lack of growth that has occurred. So I'm a fact and data-based oriented person. And unfortunately, when you array all the facts, again, you can pick and choose and have data that dramatically supports one side or another, which is why I think this is a really tricky thing. And it's not really on party lines. There are Democrats who are not for it. There are Republicans who are for it. So here's another one where there's a lot of gray area.
And Mike, if I'm reading the tea leaves correctly, is it unlikely that the $15 minimum wage passes?
So two separate questions here. One is, does it get attached to this stimulus bill? That decision is going to come out here in the next couple of days as to whether it sort of fits from a parliamentary standpoint into this bill, because there's a whole bunch of rules around that. I wouldn't be surprised if it gets tossed out. And like so many things in Washington, I would bet that later this year, if not relatively soon, you do get a minimum wage hike, but not to $15. That this is a perfect for compromising at 11 or something like that. So I think your most likely outcome is, say by the end of this year, you've got an incrementally going up minimum wage to something in the middle between where it is now and $15.
I recognize the name on this from this question, who happens to be a CPA, is asking whether there's any thoughts on whether tax season could be extended again until July.
So I've been talking about this. In fact, the news of the day is that the IRS just extended the tax season for people in Texas. So they've given 2 months to Texas residents and businesses extension because of the impact of the storm and everything else. I gotta say, I think that there's a very good chance that the tax season gets extended by a couple of months. There are so many factors. When you think about the IRS, working from home, still got a backlog of mail, 2-week delay to the start of the season. They're in the middle of stimulus checks for December. They're going to have another round of stimulus checks potentially coming. It seems very, very possible that we'll see an extension to, say, June 15th. That's what they just did for Texas.
So this is sort of a related question. Somebody, their question, if it is a question, says gold or Bitcoin. Maybe,
Hey.
I don't know
the
answer to that.
Really,
Maybe.
you're going to toss that one to me, Mike, huh?
Oh, yeah.
All right.
And there's another unrelated, question from somebody else about whether we think we will see a, Bitcoin start adding that to their balance sheets, I guess similar to what Tesla has done. So I guess maybe a thoughts on Bitcoin and
I'll start with that latter piece of it, because there's still a lot that's misunderstood about what Bitcoin actually is and how to deal with it from an accounting perspective. And I'm not a CPA, far from it. So the CPA that asked the question might already be start rolling his or her eyes when I start to answer, because I may be a bit off on this, but just the accounting for it, because it's considered, I guess, a financial asset, not currency. So you can't write it up as the price is appreciating until it's actually sold, but it has to be written down if the price is going down. It is not a true currency. It's not a store of value. It's not backed by anything. I would love to hear Mike's perspective on Gensler, who's actually an expert on cryptocurrencies, and whether that in the near term is going to be a focus in terms of regulation. I think that has the potential to be a big deal, because right now, treated as an asset, if you say sell Bitcoin to buy a Tesla vehicle, you pay a capital gains tax on that, let alone just the massive volatility. So gold is actually a store of value. It's also not a consistent and common medium of exchange other than for barter. We don't walk into a store with gold bars, but just the volatility associated with the price of gold. We've never seen anything like it in gold prices. So I think it's sort of captured, obviously, the mindset, especially of a lot of the same day traders, and you've got the Elon Musk factor in driving it in the short term. But I think it's kind of replacement for fiat currencies and representing a true currency as we see it. That is way down the road, and as a result, it's kind of a speculative trade at this point. Even if the blockchain technology and Bitcoin itself is with us, that doesn't mean you don't have a price bubble. The internet wasn't the bubble. It was the price of the stocks associated with in 2000. The internet is still with us and has been a game changer. So we have to differentiate kind of valuation and price with whether the underlying sort of technology is valid down the road.
And now I'll just add that I do think the SEC takes this up at some point this year. As Liz Ann mentioned, Gary Gensler, the nominee, is an expert, and he's actually been teaching classes on this topic. The place that you might see this kind of incremental progress forward, there's been multiple companies over the last several years that have proposed a Bitcoin ETF, exchange traded fund, that has been rejected by the previous SEC. Now Canada has one, other countries have one. I would not be surprised to see that as kind of the entry point to regulating or adding more regulation to this space is the approval of a Bitcoin ETF at some point in the not too distant future.
I am really glad to know that I am not the only one that cannot properly explain Bitcoin. Anyway, it is 4:57, so I'm going to just wrap up. And first of all, I would just like to thank Mike and Liz Ann for joining us today. We appreciate your thoughts and words of wisdom. And to our guests, thank you for joining us as well. If you want to follow up with us to discuss anything you heard today, please just call or email, and we will be happy to get back to you. With that, thank you all, and everybody have a nice evening.
Thanks, Bob.
Bye.